Okay, so here, chapter 11, we're going into the saving and investing options. So chapter 10, we just did the basics of saving and investing. And then we talked about the reasons, the principles, different strategies. And today, or this chapter, we're going to break down the low risk, medium risk, and high risk choices, starting with low risk today. So our two objectives are to talk about the low risk savings options and their features, and then the investing options and the disadvantages and advantages of those. So first thing, illiquid means it's not convertible to cash quickly or without penalty. So we've talked about liquidity, how quickly you can convert something to cash. So illiquid means it's not convertible to cash quickly or without penalty. So you want to make sure that you have some liquid assets so that you can have that as an option. So the liquidity return trade-off, the more liquid the account, the lower the return. You can get a higher return by giving up some liquidity. So if you can easily get your money out, you're going to have a lower return. Again, you can get some higher returns by giving up some liquidity, meaning it's harder to get that money out. So some low risk saving options include savings accounts from a bank or a credit union. Those can often help with your short-term needs. You have your 6-month savings in there. Maybe you're also saving for some of your goals, your personal goals. Savings accounts usually don't have withdrawal penalties, so they are very liquid. You can go walk down to Travis Credit Union or Wells Fargo or whoever it is and take money out of your savings account. Sometimes they do have a restriction, maybe only 3 times per month or 6 withdrawals per month. They do vary. A money market account is another low risk liquid savings option. So you can get them at most banks. There are two different types of money market accounts. There's a money market deposit account and a money market fund. So a money market deposit account is a bank account similar to a savings account. It is FDIC insured. Remember, that means the government backs it up to $250,000. Money market accounts pay the market rate of interest. And then a money market fund, it's not a bank account, but it's invested in low risk securities like US Treasury bills. So it is not FDIC insured. So it's a type of mutual fund, but they're short-term securities. So the chance of losing your money is very low. On average, a money market fund will have a higher rate of return than a money market deposit account. Similar to savings accounts, money market accounts will typically have a limit on how many withdrawals you can do in a month or a certain time period. You may have to keep a minimum balance in those accounts as well. They offer, though, more competitive rates. So they are a better cushion against inflation than your savings account. Your savings account typically isn't going to account for inflation. All right, so what is a CD? Let's see if this link works. I meant to check it this morning, or if it's the right one. I had 2 CD videos.
If you're looking for a savings product that may provide a greater return than the average checking or savings account, you might consider certificates of deposit, or CDs. CDs are purchased directly from an issuing bank, and while they are available in varying denominations, they are often available for a deposit of $1,000. Certificates of deposit have a preset term, typically ranging from 1 month to several years, for which you essentially agree not to withdraw your money. In exchange, the issuing bank pays a fixed rate of interest for the duration of the term. Some institutions may even offer higher interest rates for larger deposits. When interest is paid, you can typically receive disbursements via check. You may reinvest the interest into the CD account. While receiving a check is a more liquid option, reinvesting provides the opportunity to earn compound interest or interest on your interest. Two terms to be familiar with when considering interest rates for CDs are the annual percentage rate, APR, and the annual percentage yield, APY. The APR is the fixed amount of interest paid in 1 year, while the APY is the amount of interest paid in a year when compound interest is taken into account. One benefit shared by many certificates of deposit is the backing of the Federal Deposit Insurance Corporation, or FDIC. The FDIC currently insures certificates of deposit for up to $250,000 per account registration per bank. If you want to invest more than this amount in CDs, you can split up your investment among several banks in order to receive additional coverage. In the past, investors who wished to split their investment among several banks had to actually go to each of those banks to purchase CDs. Zions Direct offers a couple alternatives to this older approach. Investors now have the ability to browse through the inventory of Zions Direct's online bond store, which includes FDIC-insured CDs from a variety of bank issuers, or participate in a Zions Direct FDIC-insured CD auction for a chance to receive a competitive yield. Keep in mind that CDs are considered time deposits, meaning although you may be able to access your funds, you will incur a penalty for withdrawing prior to the maturity date. This limit to liquidity is one of the risks associated with purchasing CDs. Interest rate and reinvestment risk are also factors to consider. When your CDs reach maturity, there is a chance that the interest rate environment will be less favorable, making reinvestment less profitable. To determine whether CDs are a good choice for you, be sure to consider your current financial situation, short and long-term goals, and risk tolerance. To learn more about this and other financial
Okay, so that was a little bit more on CDs. So just they pay a higher rate of interest than savings or money market accounts, but they're not as liquid as, and they are subject to withdrawal penalties. That should be an and, not an as. So they are a time deposit, meaning you aren't supposed to touch them for that amount of time, whatever you specify. They have a maturity date, the date on which an investment becomes due for payment. So they can typically be ranging from a few months to 5 years. So that's when your money is locked in until. The benefit of that is you know exactly how much money you will be getting out at the end of that term, whatever your term is on that maturity date, unless you withdraw early. The early withdrawal penalty is a fee imposed to discourage depositors from withdrawing the money before the stated time period. So hopefully you never have to do that. But it is an option if an emergency comes up, but it should be money that you are okay putting away and not needing. They do have jumbo CDs if they're $100,000 or more. They can offer higher rates of return. So this scenario here, this example from your book, so you're putting $5,000 in, the interest rate is 5% yearly, and you're committing to 5 years. A lot of fives going on there. So you're putting $5,000 away, and it's locked for 5 years. If the money is withdrawn before 5 years, the imposed penalty will equal 365 days interest, whether you earned it or not. So if you put this money in and you decide you need it out in 1 month, you're still paying a year's worth of interest. So if you withdraw after 180 days. So $5,000 times 5% times 180 out of 365, you earn $123.29 in interest. But you're paying a $250 penalty. You're paying a 5% 1-year penalty. So you add your interest, but take the early withdrawal penalty. So you're actually only going to get $4,873.29 back, which is less money than you put in. But 6 months down the road, if something comes up, you may have to do that. I don't recommend it. Hopefully this is money when you choose to invest or put your money stored in a CD. It's money that you aren't going to need. Life insurance savings plans. So there are permanent life insurance, which is different than term life insurance. So permanent life insurance can accumulate savings called its cash value. There are penalties for withdrawing early. It's not a bank account, so it's not FDIC insured. So it's a low risk option, but it's not a great savings option, in my opinion. But again, some of these permanent life insurance policies have cash value. To build cash value, when you pay your premium, your bill every month, some of that bill goes towards in an investment account, so it earns interest. And then there are brokerage accounts. So it's an account opened with a brokerage firm. It may pay interest. Sorry, I thought I was going to sneeze. Maybe use like a checking account and can use to buy investments, but it is not FDIC insured. So you open an account at an investment company. They may pay interest like your regular savings account. They don't have to. That'll be some of your terms. So they take that money, they buy items, and then when money is earned, they put that money back into your account. Interest is not high on these, but it may be higher than your standard savings account at the bank. So they're not FDIC insured, but they are considered safe if you go with a well-known, reputable investment company. If you're putting this in a startup company, that's not then considered low risk. All right, bonds. Bonds are a loan that a buyer makes to the bond issuer at a fixed interest rate, which is why they are called fixed income securities. We saw some of these in our video the other day about the stock market. So bonds are sold at face value, which is the amount the bondholder will be repaid at the maturity date. Bonds are issued by the government, so they can be a U.S. Treasury bond, a municipal bond. Companies offer corporate bonds as well. So how do you make money on bonds? So you can sell bonds before the maturity date for a price higher than you paid for it. So a premium bond is a bond that sells for more than its face value because it pays interest higher than the market interest rates. So again, you pay more than the face value for it, but it has higher interest rates. A discount bond sells for less than its face value because it has interest rates lower than the market interest rates. You can also earn interest on the bonds you own. So the coupon rate is a fixed rate of interest that is paid semi-annually for the life of the corporate bond. So corporates or companies will issue bonds to raise money. Basically, it's that company is borrowing money from you. Here's going to be an example on the next slide. So this is a corporate bond. So the face value is $5,000. It has a discount rate of 4% and a coupon rate. So remember, the coupon rate is the fixed rate of interest paid semi-annually. So the coupon rate here is 4% and the term is 2 years. So there's a 4% discount. So $5,000 times 4%, you get a $200 discount, which means you buy this bond for $4,800. The semi-annual interest, so 4% of $5,000 again is $200 per year. You get semi-annual payments, so you get $100 twice a year. And then you get that for 2 years, so you get $400 in interest. So at the end of the second year, you get $5,000 for this bond. You redeem it for the face value. But you've also gotten the $400 in interest. So you get $5,400 total, right? You got 4 $100 payments, and then you also got this $5,000. You only put $4,800 in. So you made $600 in profits, or your return on investment here would be 12.5%. So bonds may be something that interests you. Remember, you are loaning money to that company or to the government. You do want to be careful. They are backed and they are legally binding, but with some companies, if they file bankruptcy and they're kind of a startup company and they go under, if they were to get their bankruptcy forgiven, bonds are something that the judge might say might not have to be paid back. But they are legally binding. All right, so there are different types of corporate bonds. There's a callable bond, which is a bond with a clause that allows the issuer to repay the bond before the maturity date. So say you buy this bond now and it's a 5-year bond, so they would be paying you back in 2026. But maybe they get the money ahead of time and pay you sooner. There will be a clause in there for that, though. So it's not just something they can choose to do at any time. A convertible bond is a bond that can be exchanged for shares of common stock at the option of the bondholder. So if you see the company is doing really well and or you are willing to take more of a risk, you could turn that bond into stocks. With just kind of converting it that way. Remember, stocks are riskier than bonds. Some investors really like convertible bonds. They find them attractive because it gives them more flexibility, right? They can choose to turn this into stock, or they can choose to just exchange the bond for face value when the time is up. A zero coupon bond is a type of corporate bond that is sold at a deep discount, does not provide interest payments, and is redeemable for face value at maturity. So the book says they are typically sold 50 to 75% below face value. So you can buy a zero coupon bond for $9,500, but in maturity, in 10 years, you would get $19,000 for it. You can also make money by selling the bond before maturity at a higher price than you paid for it, but you're not going to get any interest. You're just going to get face value, but you are paying a lot less ahead of time. All bonds are taxable on that interest that you are making. There are, is that on the next slide? Maybe. There are risks associated with buying bonds. So the default risk, which I was already saying, is that the company or government may not be able to pay you back. So they default on that bond and don't pay you. There's a bond rating, which tells the investor the risk category that has been assigned to a bond. So Moody's, S&P, and Fitch are agencies that rate bonds from investment grade, AAA, to very risky speculative bonds, also known as junk bonds. So you don't necessarily need to write those agencies down. But if you are considering investing in bonds, you would want to do a little bit of research. You want to figure out their grading. How well, before I invest in this company, where do you think they're going to fall? There's also an interest rate risk. Bonds pay a fixed rate of interest. So if the market rate rises, your bond is losing value. And then inflation risk. If inflation rates rise, there's a risk that the real rate of interest on your bond could go to 0% or even negative. So that interest rate and inflation rate are kind of related. If the market rates rise, there could be an association with an inflation risk. All right. Municipal bonds are issued by states, counties, cities, and towns to pay for projects like roads and buildings. The interest is usually lower than corporate bond interest, but it's exempt from federal and state and local taxes, making them attractive to investors in the high income tax. So municipal bonds, those are going to be things you may, when you guys are eligible to vote, you may see those on ballots come time to vote, where the city can be like, hey, we need to redo these roads. Are you willing to have this bond for this much money? These ones, again, they're exempt from the taxes. So that's why they're attractive to the investors in the high income tax brackets, because it's a way for them to make money and not be taxed on it, because they already feel like they're being taxed enough, and they might say, okay, how can I make some money and not be taxed? U.S. government savings bond is a loan to the U.S. government, so they are generally considered safe. You can get savings bonds with terms from 1 year to 30 years. There's different types of them. There's Series EE and Series I, which is adjusted for inflation. You can buy them online. They are subject to federal tax, but they are exempt from state and local taxes. So they make a good tax shelter, which is allowing you to legally avoid or reduce some of your income taxes. So there's also U.S. government treasury securities. I do not need you to know all of these different types. They're on here for reference. They're in your book. But a treasury security is a loan to the U.S. government, so generally considered safe again. They're subject to federal but not state or local taxes. So the same thing here for the treasury securities as the savings bond. You can get them at the bank, online. So there's 4 types. There's treasury bills, there's treasury notes, treasury bonds, and treasury inflated protected securities. Your book has a paragraph about each one of those if they are something that interests you. Again, when you are ready for investing options, they may be something that you look into. Of course, before you invest, hopefully you remember this class, but then you think, what more research do I need to do before I jump into this? And then an annuity is a contract in which you make a lump sum payment or a series of payments that earn interest and in return receive regular disbursements, often after retirement. They are issued by life insurance companies, so they are not FDIC insured, and they're only as safe as the life insurance company issuing them. So I know we've talked about annuities way back. I don't remember what chapter it was when we were talking about taxes. So with an annuity, you can either pay once or you can make regular payments into it, kind of like different types of savings accounts or savings plans, I should say, not accounts. And then you're going to get equal payments. Again, they're usually in your later years of life, in retirement. So annuities can be set up for the rest of your life. You will get this payment in return every month, or they can say until you reach age 80 or reach age 85. which people often set them up to where they plan on reaching their life expectancy, right? You don't want this money to run out at 85 and you live to be 92, if that's money that you are counting on having every month. The taxes on annuities are deferred until you receive your payments, which again, you are usually in a lower tax bracket than you were when you first were putting money into them. But again, they're only as safe as the company you invest in or trust with your money. So you will want to do your research and make sure it is a well-known or backed company beforehand. All right, so that is it on our slides for today. So for your Google Classroom, you have questions 1 through 11 and then 13. So only 12 questions today on your Google form for your classwork for the week. So you have 11, one is tonight. And then earlier in the week, you had the stock market intro homework, the stock simulation, the stock market math problems from yesterday, and then you have your notes for the week, which were on Monday, Wednesday, and then today. That's it. If you have questions, tomorrow you have this quiz that's scheduled at 8 a.m. due by 3 p.m. It's all on that stock market. You can go back. The notes are posted here. So you can go back and look through the notes and watch the videos again if you need to, but please get that quiz done tomorrow by 3 p.m. for your attendance. Other than that, I hope you guys have a great weekend. Only 2 weeks of school left, and I will see you Monday.